Hi all, welcome to this video. So there are many videos out there on the basics of technical analysis, but the one thing that they fail to explain is how candlesticks represent the way humans think and behave. Because in the end, candlesticks represent price and price is determined by us humans. So in this video, we are going to fill the gap and make sure that the next time that you see a candlestick, you exactly know what the market is thinking. So in this video, we will first understand what is technical analysis and why is it important to do a technical analysis. And second, we will understand the anatomy of a candlestick using practical example. Technical analysis is a technique which is used to find buy and sell opportunities in the market based on price movements. Why technical analysis is important is because history tends to repeat itself. That is, whatever has happened in the past will also happen in the future. Hence, price always tends to move in a pattern. Technical analysis is used to identify these patterns and maximize the gains on your investments and trades. So in the end, just remember this. Technical analysis is used to forecast the future performance of any security based on the past performance of its price. Before we deep dive into candlesticks, we should also know that there are other charting techniques as well, like line charts and bar charts. But the candlesticks are the most popular ones and there are reasons behind it. The line charts give information only about the closing price in a day, but it doesn't give you any information about the open, low or high price points at any particular given point of time. On the other hand, the bar chart gives you all the information about different price points, but it is very visually unappealing. So to sum this up, candlesticks are both visually appealing and also provides information about different price points. Hence, it is the most widely used. So where do you think candlesticks get the name from? So there are no surprises there. The names come from a candle. So if you look closely, a candle consists of two parts. So the wax portion is also called as the body of the candle and the tip part is also called as the wick of the candle. So now that you know what a body and wick is, let's check the candlestick that we use for technical analysis. Now please don't get overwhelmed by looking at this. We will slowly try to understand this picture step by step. So similar to a candle, the green and red solid part is called as the body of the candlestick. And if the wick is present at the top of the body, then it is called as the upper shadow. And if the wick is present at the bottom of the body, then it is called as the lower shadow of the candlestick. Now what does a green and red candle signify? The green candle means that the price of the stock has gone up at any particular given day. Hence, the green candle is also called as a bullish candle. The opposite of that is the red candle, which means that the price of the stock has gone down in that particular given day. This is called as the bearish candle. Now you'll also see open, close, low and high written on the image, which simply represents the different price points that the stock has seen during the day. Now let us understand these terminologies and price points using an example which should sound like a typical stock market movie. So let us begin with the bullish scenario first. So a stock started trading today with a price of rupees 100. So open is rupees 100. Now on any given day, the stock price goes up and down, right? So the price started to go down and the lowest price at which the stock was available today was rupees 90. Now suddenly some good news came up in the media and more people started buying the stock. Due to this, the price went higher and higher and touched the highest price of rupees 50. Now some people are happy with the profit, so they started to sell their position and book the profit. Due to which the stock started to come down a bit and finish the day with a price of rupees 140. So close is rupees 140. Now this was the bullish scenario. Now let us understand a bearish scenario for the same stock. So for simplicity, let us assume that on the next day, the opening price is equal to the closing price of the previous day. So open is equal to rupees 140. Now there was a good news on the stock the previous day. So the good news had a bit of hangover and the price increased a bit and touched the highest price of rupees 150 again. Now like a good thriller movie, things took a U-turn. So the good news that came out yesterday was found out to be false. अब जो लोगों ने good news के चलते stock खरीदा था उनका तो दिल टूट गया and they got panicked. So they kept on selling heavily, which pushed the price to the lowest price point of ₹90 for the day. So like a Bollywood movie hero, the long-term investors came into the picture. So they realized that nothing has really changed in the last 2 days. So they bought a bit at the bottom, and because of this the price increased a bit and closed trading at ₹100. So I hope now you understand how a candlestick is a good visual representation of the open, close, low and high price points of any stock. So that's it for the video guys. I hope you liked it. So I have decided to make more videos on technical analysis as a series, and in the next video we will discuss how single candlesticks form a pattern in itself and what are the market sentiments behind those candlesticks. So till then, see you, take care and bye bye.